China just gained the upper hand in a conflict America was convinced it was winning. Scott Bessant demanded Beijing surrender its currency weapons, a bold challenge aimed at forcing China's hand. But instead of Beijing folding, it was the US dollar that took a staggering blow, collapsing under the weight of its own miscalculations. Now, American factories are strangled by tariffs they imposed themselves. Ocean freight from China has plunged by 60%, and shelves in US stores face the very real threat of running empty in mere weeks. As Washington scrambles to contain the fallout, even Trump's aggressive order for Britain to sever ties with China has been met with cold silence. Behind the scenes, Beijing isn't reacting hastily. It's executing a carefully crafted strategy. This isn't just policy. This is economic warfare, fought in boardrooms and trading floors rather than battlefields. So what happens when your closest ally refuses to follow the playbook you wrote, and your fiercest rival starts penning the next chapter, one that leaves you scrambling to catch up? Bessant's call for China to maintain a strong yuan as the US dollar weakened was meant to reset global manufacturing balances, but it was a gamble that backfired spectacularly. Since January 2025, the US dollar index has plunged nearly 10%, from 105.2 down to 94.8, a collapse that was supposed to ignite a manufacturing resurgence in America. Instead, it has sent shockwaves through supply chains still deeply reliant on Chinese components, igniting cost pressures and inflation rather than the hoped-for boom. Tariffs, some soaring as high as 145%, were designed to force China to retreat inward, to stifle its exports and protect American industry. But with key intermediate goods blocked and domestic manufacturing infrastructure still fragile and underdeveloped, the result has been the opposite. The dollar's decline is feeding inflation, pushing costs through the roof instead of stimulating exports. You can't devalue into a supply shortage, cautions Mark Zandandi, chief economist at Moody's, describing a perfect storm where tight inventories collide with soaring import expenses, choking the very industries tariffs were meant to protect. Meanwhile, the yuan has held steady, devaluing only 3.2% year-to-date. Beijing isn't blinking, it's calculating. Markets have noticed. In April alone, investors placed $17.22 billion in net short positions against the dollar, signaling confidence that Bessant's high-stakes play is unraveling. The dollar's sharp drop should have made U.S. exports cheaper, but instead, manufacturers are grappling with skyrocketing input costs tied to their dependence on Chinese goods. In stark contrast to the 14.5% yuan devaluation during the 2018 trade war, China's policymakers have quietly maneuvered to turn this moment to their advantage. The People's Bank of China slashed its one-year loan prime rate to 3.35% in March, stoking domestic demand while maintaining currency stability. HSBC strategist David Bloom warns this soft dollar environment, without a viable American industrial substitute, risks plunging the U.S. into stagflation. Stagnant growth paired with soaring inflation, rather than revitalizing exports. Bessant's unresolved contradictions are now weapons in China's hands, wielded with ruthless precision and patience. Meanwhile, American retailers are trapped in a countdown they can't stop. By April 2025, shipping volumes from China to crucial U.S. ports like Los Angeles and Long Beach had collapsed by 61%. The National Retail Federation has sounded the alarm. Major chains like Walmart and Target will face critical inventory shortages within 5 to 7 weeks unless imports resume. The tariffs, ranging from 75% to 145% on essentials such as electronics, auto parts, and textiles, have sent consumer costs soaring. Landed costs for electronics are up 32%, imported furniture has jumped 45%, and the consumer price index for core goods spiked 1.1% in March, marking the steepest inflationary pressure since 2021. Washington insists these tariffs are temporary leverage, but the ticking clock grows deafening. When Bessant championed a rebalanced global economy driven by American manufacturing, he overlooked a brutal reality. The U.S. industrial ecosystem is still being built. The Federal Reserve's March 2025 Industrial Production Report reveals factory output contracting by 0.6% month over month, with capacity utilization falling to 76.8%, signals that reshoring efforts are far behind schedule. Producer prices climbed 1.3% in Q1, pushed by rising costs in construction materials and imported machinery, both deeply intertwined with Chinese supply chains. The labor market isn't filling these gaps either. U.S. manufacturing job openings dropped 17% year-over-year in February. Without stable inputs, skilled labor, or scaled-up domestic output, the weaker dollar doesn't stimulate growth. it multiplies costs. Economist Mohamed El-Iran puts it plainly. This is not dollar diplomacy, it's dollar dysfunction. Markets have taken note and are reacting accordingly. Behind the scenes, Beijing's central bank has shifted into a calculated stance, leveraging the falling dollar as cover to unleash targeted stimulus while safeguarding export competitiveness. The yuan has traded in a tightly controlled band between 7.19 and 7.25 against the dollar since February, even as the US currency plummeted. This stability gave the People's Bank of China the latitude to inject over $1.5 trillion, about $210 billion, into state-owned banks through low-interest lending facilities, bolstering the domestic economy without rattling the currency. Exports remain robust. China's March trade surplus hit $13 billion, buoyed by a 17% surge in shipments to ASEAN countries and Latin America. They're buying time, meticulously rotating growth inward without sparking capital flight. Beijing's approach is surgical, not reactive. By holding the yuan steady amid global economic chaos, China isn't merely weathering the storm, it's mastering it, rewriting the rules with cold precision while America scrambles to keep pace in a battle it once thought won. The implications are profound, as the balance of economic power quietly shifts beneath the surface, setting the stage for a new global order where America's dominance is no longer guaranteed. As the dollar steadily drops, China is deftly defending both its manufacturing base and its monetary flexibility, quietly reshaping global economic dynamics. Meanwhile, the UK finds itself trapped at a fraught crossroads, caught between geopolitical allegiance to the US and the harsh realities of economic interdependence. Pressure from Washington to sever trade ties with China has escalated sharply. Peter Navarro's April 2025 salvo in The Telegraph branded Britain a compliant servant of Communist China, echoing a behind-the-scenes push from the US government demanding London halt Chinese imports rerouted from the American market. But the stark numbers tell a more complicated story. In 2023, China accounted for just 7.3% of UK imports and only 4.1% of its exports. Cutting those ties abruptly would strike a devastating blow to key sectors, especially electric vehicles, where British manufacturers depend heavily on Chinese batteries and components with no immediate European alternatives. Chancellor Rachel Reeves didn't mince words, declaring, "It would be very foolish not to engage with the world's second-largest economy." At the same time, the London Stock Exchange moves forward with evaluating Shine's IPO, despite bipartisan scrutiny in Parliament, signaling that pragmatism still holds ground. The question now is no longer whether the UK wants to comply with Washington's demands, but whether it can, without detonating its own industrial future. Despite the blistering rhetoric from US officials like Navarro, who portrays Britain as a pawn of Beijing, London is quietly resisting American calls for full decoupling. Reeves's blunt warning echoes amid sluggish productivity and widening trade deficits. Walking away from China could prove catastrophic. The Office for National Statistics reports that trade with China totaled nearly £62.6 billion in 2023, representing nearly 7% of all UK goods movement, critical for industries like electric vehicles and pharmaceuticals. Simultaneously, the UK is courting Chinese investment, with the potential Shine IPO underscoring its divergence from the US decoupling strategy. A leaked cabinet briefing revealed internal resistance to Washington's tariff coercion, with senior advisors branding US demands as economically self-destructive. As the US escalates pressure, Britain pivots quietly toward resilience, not blind alignment. Navarro's venomous claim that, if the Chinese vampire can't suck the American blood, it will suck the UK dry, begins to unravel under scrutiny. China's outbound investment into the UK actually shrank 27% year-over-year in 2024, according to the Rhodium Group. British regulators have blocked Chinese involvement in sensitive sectors like nuclear and telecom infrastructure, exemplified by the Huawei 5G ban driven by MI5's security advisory. Navarro's ideological framing ignores these facts, pushing simplistic narratives at the expense of strategic subtlety. Fiona Hill, former U.S. National Security Council advisor, cautions that London's moves are calculated, not capitulative. The real danger lies in mistaking inflammatory rhetoric for actual policy. For the UK, trade remains a negotiation table, not a battlefield, betting on moderation rather than maximum pressure as the currency of influence. Both economies strain under pressure. The trade war has shifted from leverage to optics. In the US, a Q1 2025 GDP contraction of 0.3% and a 1.1% drop in real wages forced the Trump administration to spin tariffs as a win, despite soaring import costs. Meanwhile, Britain wrestles with 5.3% youth unemployment and a housing sector battered by a 22% plunge in starts year over year. Dr. Went Tai Sun of the Australian Centre on China in the World describes this as a two-level game. Leaders manage foreign brinkmanship, even as they seek to project control at home. Trump's narrative pushes industrial resurgence, while the UK focuses on resilience and multipolar strength. Neither can afford to blink first, because behind every customs declaration lies a political campaign ad. As domestic pressures mount, the risk grows that policy distortion will overshadow economic logic. Publicly, Washington and Beijing maintain that negotiations remain possible. Privately, neither wants to move first. China's Ministry of Commerce says it is assessing talks, while U.S. Treasury officials claim the door remains open. But all this ambiguity is deliberate. A Weibo account tied to China Central Television bluntly states, "The U.S. must be the more anxious party." Treasury Secretary Scott Bessant echoes this cautious hope, telling IIF delegates there's real opportunity for a deal if China is serious. This diplomatic dance, known as constructive ambiguity, has deep Cold War roots, allowing each side to preserve face while probing for compromise. The world watches two superpowers locked in silent positioning, where the first to speak risks losing the narrative. Meanwhile, financial markets tell their own story. By late April 2025, CFTC data reveals $17.2 billion in active net short positions against the US dollar, up sharply from $9.8 billion in January. Driven by deteriorating fundamentals rather than speculation, Bloomberg's dollar index has fallen nearly 10% year-to-date, battered by trade imbalances, policy uncertainty, and plunging import flows. The yield spread between 10-year U.S. Treasuries and Chinese government bonds has tightened to just 32 basis points, the narrowest gap since 2006, undermining U.S. assets' allure. This is no longer just about trade. Morgan Stanley's Ruchir Sharma warns, the dollar itself is becoming a casualty of American industrial unpreparedness. China, in contrast, is managing a gradual yuan float while rolling out a massive 1.5 trillion yuan stimulus without triggering capital flight. The very financial system that once safeguarded U.S. dominance is now enabling a reversal. If the dollar continues its slide, Beijing may not even need to retaliate. It can simply wait. This trade war has escalated beyond bilateral rivalry, cascading into multilateral realignment. WTO data shows China's exports to BRICS countries surged 19.4% year-over-year in Q1 2025, while exports to the U.S. plummeted 31.7%. At the same time, EU internal trade rose 12%, fueled by strategic stockpiling and alternative sourcing. Caught in the middle, the UK juggles parallel negotiations, pressured by Washington to lower non-tariff barriers on U.S. agriculture, while trying to preserve frictionless trade with Brussels. This is Globalization 2.0's ultimate stress test, warns historian Adam Tooze. Nations forced to choose between dollar-centric security and UA-enabled affordability risk fracturing alliances. What emerges may not be new blocks, but a tangled web of economic loyalties shaped less by ideology and more by inflation rates, labor costs, and shipping routes. The world isn't decoupling, it's repricing. So who really shapes the future of trade? Governments? Investors? Is this a passing phase in a larger standoff, or the birth of a new world order without a single center of gravity? Drop your thoughts in the comments. If you're finding this insightful, please like and subscribe.